Well, hello, everybody. I'm Ed Parcaut, host of Real Estate Jerky. But here today, like we've been doing for the last couple of weeks, I'm with Bobby Atkins. We're talking about different topic. I think today's topic's like 101.5 prepaids. And what I'm going to do is, oh, by the way, hello. Thanks for being here today.
Thank you so much, Ed. I appreciate your time.
Hey, this is important to get this information out there. And I'm glad that you're helping me with it. So I'm going to move you over to the other side and you can ask your questions. All right.
Okay.
I thought I was moving you. There you go.
There we go.
It's funny, the technology.
Yeah, I know there's a lot going on.
All right. All right. So I know I said you're going to ask the questions, but this is what we're talking about, right?
Yes. Yeah. So a lot of folks know initially, once we educate them that they don't need 20% down, they know if they're going FHA, they need 3.5%, or if they're going conventional 3%.
Correct.
But what a lot of folks don't know initially until you educate them is the other prepaids. So interest, taxes, insurance, impound accounts. And so I wanted to see if you could go over just kind of briefly over that so people have an understanding that there are other expenses that they're going to be incurred besides just the down payment.
Right. So we last week, all right. So last couple of weeks we went over down payment. Last week we went over closing costs. Right. So if you guys weren't part of if didn't see that, go back. You can go to the YouTube channel for me, or you can just go here on Facebook on Bobby's channel, on his page, personal page, or his business page. You can scroll down and see that. But the other costs, so we talk about is prepaids. And basically I tell people if you do not impound your loan, which means you have your taxes and insurance amount in your payment, you won't have to set up the impound account, will have this cost, but you still will have interest costs. You'll still have some tax costs, right, for taxes. And you still will have to pay on average like a 1 year of insurance for that whole period of time. And what people don't realize is, say in California, we'll talk about here in California, say you're closing in December, right? Well, the seller has paid all the way up through to a certain point, and when they pay the tax in December, so when they close in December, the seller's going to pay for the last 5 months, and say it's the beginning of December, and then you're going to credit them for December, and that's pays that taxes. So you have that tax, plus you have your interest, and that interest would be whatever that interest portion of your payment is due, because what a lot of people don't realize is when you rent a place, you pay the moment you start on the first, right? You pay for rent and that gets going. Well, when you buy a house, interest has to accrue in order to pay it. So you say you start December 1st is you close, you don't have a payment in December. So you close in December 1st, you don't have a payment in December, you don't have a payment in January, your first payment is February. Well, you have to accrue that interest in order to pay it. But there is a portion of that during that period of time that is due, but you won't make a payment for almost 60 days.
Yeah.
So that's the first month. So you're actually paying for January interest February 1st. Am I clear on this?
Yeah, which if I can interject real quick.
Sure.
For people that are renting, a lot of them say, "Oh, my lease isn't ending for another 30 days or something like that," right?
Right.
And that's something that I always try and tell people is, okay, so even if your lease isn't ending in 60 days, if we write an offer, get in a contract, close escrow, and then you still have another 30 days before your first mortgage payment's even due, or actually like 60 days after that. So even if you're at the end of your lease, you'd still be good to purchase a home because you're not going to have a payment for 60 days after the close normally.
I always say 40. So if you close December, so if you close in the month of December, it's the same, but you don't make it. So you don't make January, right? And your first payment is February. So it could be 45 days. It could be 35 days before you make your payment. It just depends on when you close in that month. So but that interest portion of that first, of part of that payment is included in in the prepaids that you're going to do. Then you have the tax portion, which means like, say that you're setting up your impound account. Right now, we might be pulling for 6 months of taxes to be added that. So if your tax base for where we are here, on average, we use 1 1/4. So that's 1%, 1.25 times the sales price divided by 12, right? That's your monthly amount. And say that's $250. If you have to set up your impound account with 6 months, so it's 6 times $250, which would be $1,500.
I was
Sorry.
just, you're the math guy.
Just seeing if you could do the math in your head.
I
All
was
right. So you'd
listening.
have to set $1,500 into that impound account. I guess I should have had this on the side. And then you would have to add 2 or 3 months of insurance. So if your insurance is $100 a month, there's $300. And now you have $1,800 that's in your impound account, right? That you have to set up. So you have $1,800 plus 1 full year of insurance. So if your insurance is $1,200 a year, you have to pay the $1,200 plus you have the $1,800. So that's $3,000 plus your interest. So that's why I'm saying for most people, like last week we talked on average was between $300 to $3,500 for closing costs. That's on the escrow and title fees. This prepaids is about another, just on average, about $3,000 to set up the impound account. So, and that's what prepaids, but people don't understand there's a difference between closing costs and prepaids, because your prepaids have to do with whether you impound or not, where your closing cost is what is set up originally, what you negotiate with the seller and the buyer, what they're going to pay each side. And then if the lender has any underwriting fees, processing fees, any of those garbage fees. And I don't mean that wrong, but some of those are garbage fees.
Yeah.
But basically, I just want people to understand what are prepaids, right? I missed an S on there. I see. What are prepaid? Here, I can fix that real quick.
That's all right. But yeah, no, that's good because you have your down payment, you have your prepaids, and you have your closing costs.
Correct.
You know, and
those are important to know, that because a lot of times, I think we talked about this before, people aren't told this, right? When they're getting pre-qualified for a loan, they're like, they just say, here's your payment, and your down payment is 3% of 300,000 is $9,000. What about your closing costs? What about, are you impounding that? Well, if you're putting 3% down, you are impounding that. If you're doing an FHA loan, you are impounding that. We can get away with VA not impounding, which is shocking. And if you have 5% down on conventional, we don't have to impound with us. So a lot of people I tell, like I have some people buying right now, they're not limited on money, but what they're doing is they're going to transfer under that new Prop 19, where they can transfer their base to their new house, right? Because they're 55 and older. I think that's what it is. They can transfer that. So I'm like, instead of setting up the impound account now with the higher taxes that you're not going to be paying in the future, let's not impound it. You figure that out, and then you call up whoever your servicer is around February or whatever, and you say, hey, I want to set up an impound account, and you send them 2 or 3 months of impounds, and then you move forward, or you just leave it unimpounded. So.
Yeah, I think this is really valuable what we're doing, because there's a few things that are normally a surprise especially with first-time home buyers. One is all the fees associated with purchasing a home. The next would be the supplemental tax bill, which I know we've discussed before. And then okay.
Yeah, the supplemental tax bill. The only time that it's a major issue is if you're closing in. So if you buy a house from January through March, right, into April, it takes the county probably a year to reassess the fact that somebody sold that house. So we set up from the beginning what your taxes are based off of for the purchase that you're buying. So if you're buying it for $350,000, that is today's market, but the owner bought it for $150,000. Well, that's what they're paying taxes on. The difference between those two things are considered supplemental, because they finally realize, oh, we're supposed to be paid this. In the last year, you only paid the old owner's rate. Now we caught you, and now you need to pay current rate. And that's supplemental taxes. And the reason I'm bringing this up is, unless your lender cut you a check in the last year saying you have too much money in your impound account, you can just call your lender and say, hey, I have these supplemental taxes, and you send them to them, and they go ahead and they'll pay them for you. If you received a check in the last year because they said there was too much money in there, you are now going to be responsible to make that payment, because there's not enough money in your impound account because they gave it to you thinking. And that's why the first part of the year is always the biggest headache, that if you buy during that period of time, they always review the impound account, usually January, February, March.
Yeah.
So it's not a big deal. We can get around it. Call whoever call us, or I should say, when I do your loan, just give me a call and I'll explain how to do it afterwards. When you get that call or you get that letter, what you need to do.
Yeah.
Anything else?
No, I think that's good. I think you explained it really succinctly, and I appreciate your time, Ed. Thank you.
No, thank you for doing this. I appreciate it. And again, Thursday this week, we're going to go more in depth on. We saw an article in Barron's about how house prices are going to continue to. This market that we're in is going to continue for the next decade, is what they're stating, and we're going to go through that process, why they think that, and why I actually think that too. And so we'll do that on Thursday at same time, same
Yeah.
bat channel. All right.
Yes. Yep. Same time. I think that'll be something that there's going to be a lot of information in, so it might be a little bit longer than what we've been normally doing.
Yeah, I think that's more of a 20 or 30-minute talk because
Yeah.
we're gonna have charts and different things, and I'll go over the birth rates and why that's important now and what happened last time. Well, we're not going to see the same boom and bust. All
Yeah.
right. All right. Thank you,
Awesome.
Bobby.
Thanks so much, Ed. I appreciate it.
All right. Everybody have a great day and thanks for watching. And if you like what we're doing here, like it, share it, and put a little thing in the comment that you like it. We appreciate it. Have a great day.